There are three numbers I need to put in front of you before this video goes another second. Bitcoin, down 45% from its all-time high of $126,000. Ethereum, down 62% from its peak. And XRP, the token that was supposed to be the great institutional success story of this cycle, the one that finally won its legal battle. The one that launched its own ETF. The one whose CEO stood on a stage at Davos in January and declared that crypto would reach all-time highs in 2026. XRP is down 65% from its cycle high of $3.65. Three of the most widely held digital assets on the planet. Three brutal drawdowns happening simultaneously. And not one major financial network is telling you the real reason why all three are falling at the same time, or what it means for every single person watching this video right now. So stay with me, because this is not a standard price update. This is a forensic breakdown of the most complex and consequential crypto market event of 2026. And by the end of it, you will understand things about your portfolio that you absolutely did not understand before you clicked on this video. Welcome to the Wealth Continuum. If this is your first time here, this channel does one thing. It gives you the macro level analysis that helps you see what the market is doing before the crowd figures it out. Subscribe right now and drop a comment telling me where in the world you are watching from. Whether you are in the United States, the UK, Canada, Nigeria, the Philippines, South Korea, your geography matters here. Because as you will see in this video, different parts of the world are experiencing this crypto crash in completely different ways. I want to know where you are. Now let's get into the real story. Let me start with the event that most people missed. Because it happened on a Thursday, it got buried in the broader chaos, and it tells you more about the structural fragility of this market than almost anything else. On February 5th, 2026, the cryptocurrency market entered its third consecutive session of steep losses. Bitcoin was testing $70,000. Ethereum had already fallen to $2,068, its lowest level since May 2025. And XRP, on that single day, crashed more than 16% to $1.29. That made it the single worst performing major token in the entire market on that day, not some random altcoin. XRP, the fifth largest cryptocurrency by market cap, down 16% in 24 hours, while $775 million in leveraged positions were liquidated across the market. And then, less than 2 weeks later, on February 15th, something strange happened. Brad Garlinghouse, the CEO of Ripple, was appointed to the CFTC's Innovation Advisory Committee. XRP spiked 8% to $1.66 within hours of that announcement. And then, within 24 hours, it gave back every single penny of that gain and crashed 11% back down to $1.47, a spike and a full reversal in less than a day. And as of right now, February 17th, 2026, XRP is trading at approximately $1.50, down 65% from its cycle high of $3.65 set in July 2025. That sequence, spike, reversal, flat, tells you everything you need to understand about where XRP is right now, and I am going to come back to it in detail. But first, I need to set the macro stage, because without understanding the broader environment, none of the individual asset stories make complete sense. Here's what most investors think is happening right now. They think this is a standard crypto correction following an overextended bull market. They think the Federal Reserve's hawkish stance is creating temporary headwinds. They think the smart move is either to hold tight and wait for the recovery, or to dollar cost average down into assets they believe in. And look, that framework is not entirely wrong, but it is dangerously incomplete. Because what is actually happening in this market right now is not one thing. It is five things happening simultaneously, compounding each other in ways that the mainstream narrative is not connecting. But here's what most investors are missing. And this is the part where I need your full attention. On January 30th, 2026, President Trump nominated Kevin Warsh as the next chair of the Federal Reserve, replacing Jerome Powell when his term ends in May. And the market's reaction was immediate and violent. Bitcoin fell from approximately $88,000 to around $81,000 in a single session. ETFs bled nearly $1 billion in outflows on that single day. And the cascade that followed over the next 2 weeks produced the February 1st liquidation event. $2.58 billion wiped out in a single 24-hour window. 434,945 traders liquidated. One person lost $222 million on a single Ethereum position in one trade on one day. Now, Kevin Warsh is not a simple villain in this story. He has publicly said that Bitcoin, quote, exposes policy errors and could serve as a legitimate alternative store of value. Michael Saylor himself called him the first pro-Bitcoin Fed chair, and Warsh has real investments in the crypto infrastructure space. So the picture is nuanced, but what the market heard on January 30th was not nuance. What the market heard was this: a historically hawkish economist who resigned from the Federal Reserve in 2011, rather than support quantitative easing, is about to take control of the world's most powerful central bank. And the immediate implication of that, in a market running on leverage, on liquidity expectations, and on the assumption that rate cuts were coming, was catastrophic. Stay with me, because the next part changes everything about how you should interpret what you're seeing right now. The Federal Reserve held rates steady at its January 28th meeting, keeping the federal funds rate in the range of 3.5 to 3.75%. The December dot plot, the Fed's own projection, showed only one rate cut expected for all of 2026, one. And the DXY, the US dollar index, pushed higher on the back of these hawkish signals. When the dollar strengthens, it creates a tightening effect across every global risk asset simultaneously. Capital flows back to the safety of dollar-denominated instruments. Money market funds, currently holding approximately $7 trillion, become more attractive relative to anything volatile. And crypto, which is the most globally accessible risk-on asset that exists, takes the hit first and hardest. This is where it gets concerning. And I want to be precise here because the numbers matter enormously. Bitcoin's spot ETFs, the product that was supposed to be the defining institutional on-ramp of this entire cycle, saw net outflows of $6.18 billion over the 3 months from November 2025 through January 2026, the longest sustained outflow streak since those products launched in January 2024. Total Bitcoin ETF assets under management fell from a peak of approximately $137 billion to around $97 billion. And Bitcoin market depth, the ability of the order book to absorb large sell orders without dramatic price movement, declined approximately 30% from the October 2025 peak. When you take declining market depth, elevated open interest, and a macro trigger like the Warsh nomination, the result is not a gentle correction. The result is the February 1st liquidation cascade. And that cascade set the tone for everything that followed. Now, let's talk about Ethereum specifically, because what is happening with ETH is both related to Bitcoin and also driven by its own structural pressures that have nothing to do with the Fed. Ethereum's all-time high this cycle was approximately $4,946. As of mid-February 2026, it has fallen to as low as $1,746, a crash of more than 62% from the peak. ETH was the worst performer in the February 1st liquidation event, with $1.15 billion in Ethereum positions alone being forcibly closed. And the ETH to BTC ratio, the measure of Ethereum's relative strength against Bitcoin, has been in a sustained downtrend that goes beyond what the macro environment alone can explain. Here's what is really happening with Ethereum. The original bull thesis for ETH centered on it being the dominant base layer for decentralized finance, NFTs, and the broader Web3 economy. The more activity on Ethereum, the more ETH gets burned through its fee mechanism, the more deflationary pressure supports the price. That was the story. And it was a compelling story in 2021, but the crypto ecosystem has evolved dramatically since then. Layer 2 scaling solutions, Arbitrum, Optimism, Base, and others built on top of Ethereum have absorbed an enormous share of the activity that would have generated fees on Ethereum's mainnet. This is architecturally good for the ecosystem. But it creates a genuine question about ETH, the asset. Because if transactions are happening on Base instead of Ethereum mainnet, the fee burn that supports ETH's value doesn't happen at the same scale. At the same time, Ethereum's staking yield, the return you earn for locking up ETH to secure the network, sits at approximately 3 to 4% annually. Compare that to the 5% available in US short-term treasuries with essentially zero risk, and the risk-adjusted math for institutional portfolio managers becomes challenging. This is not a fatal problem, but it is a real drag on the marginal institutional buyer in a high-rate environment. And combined with the broader macro pressure, it explains why Ethereum dropped harder than Bitcoin, and why the ETH BTC ratio continues to compress. You need to understand this before I show you what happens next. Now, let's get to XRP, because this is where the story gets genuinely complex, and where most commentary you have seen has been dangerously superficial. XRP hit its cycle high of $3.65 in July 2025. That rally was driven by two things. First, the SEC lawsuit against Ripple, which had hung over the token like a cloud for years, finally reached a settlement agreement in August 2025. The regulatory uncertainty that had suppressed institutional interest in XRP for half a decade was officially behind it. Second, spot XRP ETFs launched in November 2025 and pulled in over $1.3 billion net inflows within their first month of trading, with no single day of outflows in that initial window. For context, Bitcoin ETFs saw net outflows during that same period. XRP ETFs were attracting capital while Bitcoin ETFs were bleeding it. On the surface, that setup should have been a powerful foundation for a continued rally. Legal clarity, ETF launch, institutional inflow. CEO on a Davos stage in January 2026 saying crypto would reach all-time highs. Everything in the fundamental story pointed up. And yet, the price went down 65%. Comment below if you think XRP's fundamental story is disconnected from its price action right now, because this exact disconnect is the most important question facing XRP investors in 2026. Here's why the fundamental story and the price story are telling completely opposite things right now. And this is the part that changes how you understand not just XRP, but every asset in this market. XRP's price is driven, in the near term, almost entirely by positioning and momentum rather than fundamentals. One analyst at CoinDesk put it exactly this way after the February 5th crash, and I think it is the most honest description of XRP's situation. XRP is trading like a leverage unwind disguised as a fundamental story. That sentence deserves to be read twice, because what it means is that the positive fundamental developments, the lawsuit settlement, the ETF launch, the institutional partnerships, create the narrative that attracts leveraged long positions. And when those positions become too large relative to the available liquidity, the market doesn't wait for the fundamentals to play out. It forces the leverage out, violently, and the price crashes regardless of what the underlying story says. The evidence for this is in the funding rate data. XRP's funding rate on Binance, which measures the cost of holding leveraged long positions, dropped to negative 0.028% in mid-February. That is a 10-month low. The last time XRP funding rates were this negative was April 2025. And what happened next in April 2025? The funding signal came first. Then the SEC settlement announcement landed in May, and XRP rallied 82%, from approximately $1.60 to $3.65 by July. The shorts got squeezed. The longs who held through the pain made extraordinary returns. Now, and I want to be careful here because the analogy is not perfect, today's setup has both more tailwinds and more headwinds than April 2025 did. The tailwinds: the SEC lawsuit is fully resolved, removing the legal overhang entirely. XRP ETFs are live and have accumulated over $1.3 billion in net inflows. Ripple spent $2.5 billion on acquisitions in 2025, including the $1.25 billion Hidden Road deal, building serious institutional infrastructure. Brad Garlinghouse has just been appointed to the CFTC's Innovation Advisory Committee, giving Ripple direct access to the regulatory conversations that will shape crypto's future. Standard Chartered's head of digital assets research, Jeffrey Kendrick, has an $8 year-end price target for XRP, a 430% gain from current levels. Japan's financial system, through the Mizuho Bank and SMBC Nikko-backed Financial Infrastructure Innovation Program, is actively building on the XRP ledger. The headwinds: Bitcoin is sitting near $60,000 in an environment where the fear and greed index hit 8, extreme fear. The Fed's Warsh nomination has injected real uncertainty about the liquidity conditions that historically power altcoin rallies. Unlike April 2025, when traders could reasonably hope for a Fed pivot, there is no clear liquidity catalyst on the near-term horizon. And XRP's own structural issues, the fact that banks using Ripple payments don't have to hold XRP, and the fact that Ripple's own RLUSD stablecoin competes with XRP for payments utility, raise legitimate questions about the depth of organic demand for the token versus speculative demand. The Motley Fool published an analysis on February 11th suggesting XRP could fall to $1 or below during 2026. Standard Chartered ES model has it at $8 by year-end. That is not a modest disagreement. That is a 700% gap between the bull and bear case. And that gap tells you everything you need to know about the genuine uncertainty surrounding XRP right now. Hit, like if you think the XRP funding rate signal, negative 0.028%, a 10-month low, is the setup for the next major squeeze higher. And tell me in the comments where you think XRP ends 2026, because this is one of the most polarizing debates in crypto right now. Now I want to connect all three of these assets, Bitcoin, Ethereum, and XRP, and to the single macro force that is shaping all of them simultaneously. Because the individual asset stories matter, but they all flow from the same source, and that source is global liquidity. Global liquidity, the total amount of money circulating through the financial system across all central banks, across all credit channels, has a measurable and historically consistent relationship with crypto prices. When global liquidity expands, crypto rises. When it contracts, crypto falls. This relationship is not perfect. It has led and lag times. But over 6 to 12-month periods, it is the single most reliable macro signal for crypto market direction that exists. So whereas global liquidity right now, it is under pressure from multiple directions simultaneously. The Fed is holding rates at 3.5 to 3.75%, and the Warsh nomination has raised the real possibility of a more aggressive balance sheet reduction than markets were pricing. The Bank of Japan is still navigating the most delicate monetary policy transition in decades, slowly trying to exit its ultra-loose policy without triggering a yen crisis or a Japanese government bond market implosion. The yen carry trade, where global investors borrow in cheap yen to fund investments in higher-yielding assets like crypto, is under pressure every time the BOJ moves toward normalization. And we have seen how violently that carry trade can unwind. Europe is cutting, China is cutting, but their easing cannot fully offset what the world's largest central bank is doing by holding rates elevated. And here's the part that most crypto investors have never connected before. Look at what happened in South Korea during the February crash. XRP was the most traded cryptocurrency in South Korea during the peak selling sessions, with 24-hour trading volume of $1.2 billion on Upbit and BitHum alone. That was higher than Bitcoin's Korean volume of 285 million and Ethereum's 304 million on those exchanges. Why is that relevant? Because South Korea is one of the world's most active retail crypto markets, with a passionate and highly leveraged retail base. When Korean retail traders are generating more XRP volume than BTC and ETH combined, and the volume is heavily weighted toward the sell side, it tells you that the selling pressure is not coming from sophisticated institutional holders executing orderly risk reduction. It is coming from retail traders being stopped out of leveraged positions in one of the most emotionally volatile markets in the world. And when that happens at scale, the price impact is amplified dramatically. This is where it gets concerning on a level that most people are still not appreciating. The total crypto market cap has fallen from $4.38 trillion in October 2025 to roughly $2.3 trillion in February 2026. That's a $2 trillion wipeout in under 4 months. For perspective, the entire U.S. subprime mortgage market that triggered the 2008 financial crisis was about $1.3 trillion. We'd have erased more value in crypto in 4 months than the size of the market that nearly destabilized the global financial system. Now, crypto losses are not the same as systemic banking risk. Digital assets aren't embedded in bank collateral structures the way mortgages were. But wealth destruction at this scale still has consequences. It affects consumer spending in crypto-heavy economies. It slows venture capital deployment into blockchain. It makes institutional boards more cautious about approving new allocations. These second-order effects take months to appear in the data. By the time they do, most retail investors have already reacted emotionally. So this is not just another correction. The scale is different. The macro backdrop is different. Now let's talk about what happens next. Everything we've covered, the Warsh nomination, ETF outflows, the $2.58 billion liquidation event, XRP's leverage unwind, dollar strength, yen carry pressure, tightening global liquidity, feeds into 3 realistic scenarios for the next 3 to 6 months. And you need to know which one your positioning is built for. Scenario 1, the patient base. Build Bitcoin holds $60,000 as a structural floor. The February 1st liquidation flushed $2.58 billion in forced selling. That kind of leverage purge doesn't resolve in days, it resolves in weeks. Markets consolidate, frustration builds, sentiment stays fragile. ETF outflows stabilize. BlackRock's IBIT, which continued attracting inflows even on heavy redemptions elsewhere, anchors institutional confidence. Ethereum begins stabilizing as the Layer 2 ecosystem matures and fee dynamics normalize. XRP, with negative funding rates, gradually sets up for a short squeeze similar to April-May 2025 as over-leveraged shorts unwind. In this scenario, even aggressive long-term projections, like Standard Chartered's higher XRP targets, stop looking unrealistic and start looking like positioning math meeting improving macro conditions. This doesn't feel like a bull market. It feels like slow repair that eventually turns into momentum. Scenario 2, the macro deterioration. Extension $60,000 fails. Kevin Warsh's confirmation brings a hawkish surprise, possibly faster balance sheet reduction or rhetoric that markets interpret as rate hikes returning. The dollar strengthens, liquidity tightens further. Bitcoin drops toward $50,000, Ethereum declines harder without a strong narrative catalyst. XRP faces its more extreme downside projections, including the possibility of a move toward $1 or lower technical levels if momentum fully unwinds. This scenario is brutal, but historically, the investors who accumulate during maximum stress, without leverage with multi-year conviction, are the ones who define the next cycle's outperformance. The difference isn't courage, it's preparation. Scenario 3, the Warsh surprise and the Great Rotation. This is the scenario markets are least prepared for. Warsh takes the Fed chair seat and proves more pragmatic than expected. Economic data softens, inflation cools, growth concerns rise. He signals a faster path to rate cuts than the market priced in. The dollar weakens, liquidity conditions ease. Then regulatory clarity advances in Washington. The crypto market structure framework progresses, reducing institutional uncertainty. In that environment, Bitcoin benefits from improving liquidity and potential reallocation from the $7 trillion sitting in U.S. money market funds. Ethereum benefits as Layer 2 maturity begins translating into sustainable value capture. XRP benefits from regulatory clarity and accelerating ETF flows, building on the capital already allocated. All three rise, but for different reasons, and that's the key. 3 assets, 3 theses. Bitcoin is primarily a macro monetary asset, driven by liquidity, dollar strength, and fixed supply versus expanding money. Ethereum is primarily a technology platform asset, driven by ecosystem value and network economics. XRP is primarily a financial infrastructure and positioning asset, driven by institutional adoption and derivatives market dynamics. 3 assets, 3 frameworks. Yet most retail investors treat them as one single crypto trade. That conflation is where capital gets destroyed. So as this video ends, don't ask, what will price do next? Ask, do I know exactly why I own each asset? And is that reason still intact? If you own Bitcoin for the macro thesis, short-term volatility is noise. If you own Ethereum for the technology thesis, you need to honestly reevaluate how Layer 2 evolution impacts value capture. If you own XRP for the institutional payments thesis, you need to understand which regulatory and adoption assumptions your conviction depends on, and what would invalidate them. In markets, this interconnected and macro-driven survival doesn't go to the most confident voices. It goes to the investors with the most clarity and the most discipline. The data tells a story, the macro tells a story, positioning tells a story, but the story isn't finished. The next chapter could be written in a Fed press conference. And where it goes depends, in part, on what you do right now. If you want to stay ahead of those shifts, not reacting emotionally, but understanding the structural forces underneath them, that does exactly what we focus on at the Wealth Continuum. Not noise, not hype, depth when it matters most.